That's good to know. Now, let's step back a little bit.
Sure.
For folks who might be more familiar with, getting a mortgage for their home,
hmm
how are commercial real estate loans different?
Yeah, that's a big question.
Big question.
And Michael Litton does a nice job of explaining this. Basically, commercial loans, they're specifically for properties that are used for business.
Oh,
So think office buildings, retail spaces, industrial warehouses, apartment buildings, things like that.
okay. Got it.
And one of the first things you'll notice is the loan terms are different. They're usually shorter than residential mortgages, maybe
Yeah.
5 to 10 years. But the amortization schedule, which is how long you have to repay,
Okay.
that's usually longer, like 20 to 30 years. And that often means there's a balloon payment at the end.
A balloon payment. So
Yeah.
you're not paying off the entire loan over those 5 to 10 years.
Right, exactly.
I have.
At the end of that term, you'll owe a big chunk of the principal, the balloon payment.
So you've got to have a plan for that, like refinancing or selling the property.
Exactly. As Michael Linton would say, you got to plan ahead.
Okay, what else is different about these loans?
Well, the underwriting process is a lot different, too. With a home loan, they look at your personal finances, your credit score.
Yeah.
But with commercial loans, the focus is really on the property itself.
Ah, okay.
Can that property generate enough income to cover the loan payments and the operating expenses?
Makes sense. They're not so worried about you, they're worried about the building.
Right, the building's got to stand on its own.
Okay. Anything else that's different?
Yeah, Michael Lynn also points out that non-recourse loans are more common with commercial real estate.
Non-recourse.
So basically, if you default, the lender can only go after the property, not your other assets.
Oh, that's interesting.
It gives you some protection, but they usually have stricter conditions.
Got it. So it's not a free pass.
No, not at all. And you should also know that down payments are generally larger with commercial loans, maybe 20% to 35%, and the fees and closing costs are usually higher.
All right, so shorter terms focus on property income, possibility of non-recourse, bigger down payments, and higher upfront costs.
That sums it up pretty well.
Okay, good overview.